Welcome to the Money Metals Midweek Memo, news and commentary relating to sound money, the precious metals markets, and the economy. I'm your host, Mike Maharrey. Thanks for tuning in. So, in journalism, there's a phenomenon known as burying the lead. And this happens when a reporter doesn't mention the most important part of the story until several paragraphs in. So, for example, let's say we had a city council meeting last night, and the reporter starts off by telling you that the council approved funding for next year's 4th of July fireworks. And then about 5 paragraphs into the report, he mentions that the council voted to remove the mayor from office. Yeah, that's a tad more important than the fireworks thing. The reporter buried the lead. Now, a lot of times reporters will bury the lead because, quite frankly, they just aren't very good reporters. And the fact of the matter is, it's harder to cover a story than most people think it is. In fact, if you want a kind of an interesting mental exercise, go to like a city council meeting or, some type of function like that and try to write a report about what happened. Not as easy as you might think to get everything, ordered right and write a story that's interesting and flows. It's not the easiest thing in the world. But a lot of reporters struggle with that, and they struggle figuring out the lead. I remember when I was in journalism school and, like the very first reporting class, how hard it was sometimes. They'd give you this big, long list of things that happened, and you had to get it in the right order. And it was hard. But the truth is, sometimes reporters bury the lead because they don't want you to notice the more significant aspect of the story. In other words, they're trying to keep something out of the public eye. Burying the lead is a great way to do it, right? Because the fact of the matter is, most people do not read past the headline and maybe the first paragraph of a written story. Or, if they're watching a video, they may listen to the first 2 or 3 minutes. They want to get the basic idea of what's going on, and then they move on. Well, if the real thing that's going on isn't until deep in the story, a lot of people are going to miss it. And sometimes that is by design. Well, you probably know that the Federal Reserve had a FOMC meeting last week, and you almost certainly are aware, if you follow these kinds of things at all, that they cut interest rates again. And you probably realize that Jerome Powell said a bunch of stuff, and you might know that the Fed put out its latest dot plots that kind of project where they think interest rates might be going in the future. All of that was pretty well reported, but you might not realize that the central bankers did something much more significant. They restarted quantitative easing. Now, that seems like an important detail to this story, no? Well, CNBC didn't get around to mentioning it until the 19th paragraph of its story. And the Associated Press didn't mention it at all. Well, we don't bury the lead here on the Midweek Memo, although we do long analogies to open the show. So I'm going to tell you exactly what's going on over at the Fed and some of the ramifications to the latest Fed mechanizations. But before we dig into all of that, I do want to, as always, thank you for listening to the show. I really do appreciate it. I say it every week. I know there is so much out there vying for your attention, and it means a lot to me that you spend 45 minutes or so with me every week. If you would do me a favor, I would really, really appreciate it if you would share this episode on your social media, or even better, give us the thumbs up wherever you listen to the show and write a short review. These things help, they boost up the algorithms and they help the show grow. And I think it makes the show better. So if you would do that, I would really, really appreciate it. Also, I do need to remind you that Christmas Eve is exactly 1 week from today. Do you have all of your shopping finished? I'm going to brag. I do have all of the shopping finished. Now, we have a lot of stuff to box off and ship because our kids all live out of state. So a lot of work to do, but we are finished with our shopping. But I know a lot of people aren't. Historically, the biggest shopping day before Christmas has been the Saturday before Christmas. A lot of people kind of think, well, Black Friday is the biggest shopping day. It's actually, at least in recent history, been that last Saturday. So this Saturday, the malls are going to be packed. You don't want to fight all that, right? We've got your back here at Money Metals. We have some great Christmas gift ideas for your loved ones. You can give the gift of real money, gold and silver. And if you go to moneymetals.com, right at the very top, you're going to see a little red box that you can click that says holiday gift ideas. Just click on that. It'll take you to a page that has all kinds of really cool gold and silver related items. And, who doesn't want to get the gift of gold and silver? We also have some cool things like we have these building blocks, and they're not Legos. They're actually made out of silver, and you can stack them up. You could build yourself a little silver house with these blocks. Just cool little things. So if you're still looking for some gift ideas, go to moneymetals.com, check out our Christmas gift ideas. We also have jewelry for both men and women, real high quality, 22, 24 karat gold jewelry. So check all of that out and solve your Christmas problems, and don't fight the traffic on Saturday because you may not live to tell about it. All right, so let's talk about the Federal Reserve meeting. Now, the mainstream financial media, as I kind of alluded to earlier, focused on the 25 basis point interest rate cut. That set the federal funds rate between 3.5 and 3.75%, which I can tell you is historically not very high. The mainstream media also obsessed about the latest dot plot that projects just one more rate cut in 2026 and only one in 2027. So the Fed governors were kind of hinting that they're going to slow down on this cutting, that we may be kind of where they want to be, although I'm not sure they know where they want to be. But that's the impression that they're trying to give. So the financial media sliced and diced the dot plots. And they did not focus on the resumption of quantitative easing. I mean, I guess they don't consider money printing when inflation is high a big deal. It is. So, what am I talking about here? Well, here's how the official FOMC statement explained the new move. It said, quote, "The committee judges that reserve balances have declined to ample levels and will initiate purchases of shorter-term Treasury securities as needed to maintain an ample supply of reserves on an ongoing basis." So, translating this into regular English, this means that the central bank plans to resume expanding its balance sheet. If only there was like a term for that they could use. Oh, wait, there is quantitative easing. So if you go back to the last meeting before this one, that was the October meeting, the Federal Reserve announced that it was going to end balance sheet reduction effective December 1st. And I talked about it on the show at that time, after that Fed meeting, that was a very significant move. I would argue that the balance sheet has a more direct impact on inflation and the money supply than interest rate policy. Interest rate policy kind of creates money and credit indirectly, right? It incentivizes borrowing. And when you have lending and borrowing in a fractional reserve system, it's inflationary. And so that's why they're doing it, right? They want to stimulate the economy, and they want to stimulate borrowing. And in this case, we're really cutting rates because people simply can't continue to function in a higher interest rate environment because of the giant debt black hole that is dominating the economy. And we talked about that in a show a few weeks ago. I'll link to it in the show notes page if you missed that one, because that's important context. So they had already announced that they were going to end balance sheet reduction. And when they did that, you can go back, and if you go to moneymetals.com, you can find the article that I wrote at the time. And I'm sure I mentioned it on the podcast as well. I said that I thought that the central bankers were about to restart quantitative easing. I knew it was inevitable because of the condition of the bond market. You have a federal government that is, over $38 trillion in debt, that is still running massive deficits, despite the fact that we have all of this increased tariff revenue. And the federal government has to keep borrowing, so it needs to keep the borrowing costs lower. That's the obsession with the interest rate being lower. And it's not just the federal government that is buried in debt, of course. Consumers are buried under record levels of debt. Corporations are buried under record levels of debt. So we've talked about this before, the debt black hole dominating the economy. And it's forcing policy that may not be very wise given the inflation situation. But I wondered out loud at the time if they were about to restart QE, and sure enough, they did. According to Fed officials, the central bank plans to purchase $40 million in Treasury bills, and that first purchase was going to be last Friday, the Friday after the meeting. And so Treasury bills, these are short-term treasuries. They generally mature in 1 year or less. So they're doing short-term borrowing. And from that point, the Fed said purchases will, quote, remain elevated for a few months before they are significantly reduced. Now, of course, you're never going to hear any central banker at this point or mainstream pundit utter the words quantitative easing. Those words have negative connotations. Maybe if we go back to a crisis situation where they're, printing trillions of dollars like they did during the pandemic, maybe they'll roll the QE label out again. But they're not going to say it for something like this. In fact, if you push them, they'll almost certainly deny that's what they're doing, right? They're going to call it reserve management. I think that's the term that the Fed is bandying about this time. Or, they'll tell you that they're engaged in, quote, technical operations to keep the financial plumbing moving. However, an expansion of monetary reserves is an expansion of monetary reserves. You can call it QE. You can call it reserve management. You can call it, technical operations. Heck, you can call it tap dancing with unicorns if you want to. In practice, the Federal Reserve plans to start buying Treasury bills. They're going to buy them with money created out of thin air. This will increase the money supply, and it's going to put downward pressure on Treasury rates. The balance sheet is going to grow. Liquidity is going to increase. Risk asset bubbles are going to get more air blown into them. This is exactly what QE is designed to do. So, call it what you want. But as the old saying goes, if it walks like a duck, swims like a duck, it's probably a duck. And in this case, this is definitely a duck that is known as quantitative easing. And again, they're not going to use that label. And maybe if you want to get pedantic and technical, it's not quantitative easing, but in practice, it's doing exactly the same thing. And by the way, it is also, by definition, inflation, right? I've talked about this until I'm blue in the face on the show. Inflation isn't just rising prices. Inflation is an expansion in the supply of money and credit. That is used to be the technical economic definition of inflation. So that's what we're getting, right? In effect, and that's what's important here. Labels aren't that big of a deal. What happens is what's important. And in effect, the Fed supersized its rate cut while still maintaining a somewhat cautious stance on further rate cuts. When I say it supersized its rate cut, it did a 25 basis point cut. But when you combine that with quantitative easing or technical operations or whatever you want to call it, you're basically supersizing that effect. TradeStation head of market strategy, David Russell, told CNBC that the central bankers, quote, threaded the needle by delivering a modest cut while quietly easing monetary policy even more through the back door. Quote, this gives policymakers time to get caught up on the economic data after the shutdown. It makes January a more important meeting, but it still gives investors some holiday cheer. Ah, yes, and cheer they did. Because you know what? The Fed is giving them more alcohol in the punch bowl, right? The heroin addict is getting more heroin from their dealer. They love it. the stock market rallied on the move. They were thrilled to get that easy money punch bowl back, right? It's going to get filled up faster than they thought it was. Gold saw modest gains as the dollar weakened. In fact, since the Powell post-meeting press conference to yesterday when I was prepping the show, gold was up $88. And I think it's up a little bit more today. And then, of course, you've got silver that this morning is trading over $66 an ounce. This is part of the push of that easy money. Remember, inflation doesn't just show up in consumer prices. It shows up in a lot of different places in asset appreciation. Now, the funny thing about this whole meeting, and they were talking about this before they even got to the meeting. They were calling it a hawkish cut, right? Everybody expected the Fed to go ahead and trim another 25 basis points off of interest rates. And so they were calling it a hawkish cut. Well, what exactly was hawkish about it? Right? When they say hawkish, that means it's leaning towards tighter monetary policy, less stimulus for the economy. When they're going to give you more stimulus, they say they're dovish. But this was a hawkish cut. And again, I asked the question, what exactly was hawkish about it? Certainly, nothing that Powell and company did was hawkish. They cut rates again. They announced balance sheet expansion. Those are both very dovish moves. But Jerome Powell did say some things that one might perceive as hawkish. Therefore, we'll call this a hawkish cut. Now, Powell was clearly trying to tamp down expectations of future rate cuts. And he has to do this because I think everybody in the back of their head knows that we're still in an inflationary environment. Now, we kind of got a reprieve because we didn't get any inflation data for October thanks to the government shutdown. So, in a sense, the Fed is kind of flying blind here in terms of the data. But I think we all know that we're still in an inflationary environment because we all buy stuff and we all see the prices going up. So, increasing consumer prices is one of the symptoms of inflation. So that's what's going on here. They're trying to tamp down those expectations. And so Powell kind of framed this as a wait and see situation. He said, quote, "We'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait and see how the economy evolves." So he's trying to make you feel like, we've loosened a little bit, and we've loosened quite a bit, in the past, but we're not going to do any more because we're kind of where we need to be. We're neutral, right? And then Powell also emphasized that the December cut was a, quote, close call. And I don't know how close it was. There were 3 dissenting votes. That was the first time we've had 3 dissenting votes since, I think, 2019, which incidentally was the last time we had this pseudo quantitative easing that they refused to call quantitative easing. Powell said, quote, "I could make a case for either side," he said, talking about cutting or holding steady. And he said, "We always hope that the data will give us a clear read. It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves." So again, this is the hawkish part. All of this blah, blah, blah falling out of Jerome Powell's mouth is what they're calling hawkish. And Powell did concede that there are still upside risks for inflation, but proactively blamed tariffs, saying, quote, "It's really tariffs that's causing most of the inflation overshoot." No. He said, quote, "Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem, but with downside risk to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate." In other words, the Fed is trying to do 2 things that are mutually exclusive, and they're trying to walk a tightrope while they're doing it. I've talked about this as well. I have dubbed this the catch-22 facing the Fed, and they are still stuck right in the midst of it. So, establishing a scapegoat for inflation now was probably wise, given the inflationary actions that the Fed just took while pretending like they're being hawkish. The Fed's new dot plot was also viewed as hawkish. And when I talk about dot plots, so every few meetings, the Fed will put out these plots, and each of the governors kind of tells you what he or she expects interest rates to do in the coming months and years. And so this new dot plot was viewed as hawkish, and I think it was intentionally framed that way because, as I mentioned earlier in the show, it calls for just one interest rate cut next year and then one more in 2027. However, when you actually look at the dot plots, you can see that there is a wide divergence among committee members on the future trajectory of rates. There are some that are much more dovish, some that are more hawkish, and quite frankly, I've said this before, these dot plots are virtually worthless. The FOMC members are notoriously bad at projecting the trajectory of interest rates, which is kind of funny because they're the ones that are literally setting them and they can't figure out where they're going in a year. And the track record is bad. How bad is it? Well, a fund manager named David Hay analyzed past dot plots, and he found that the FOMC only got interest rate projections right, get this, 37% of the time. And as Hay pointed out, they control the interest rates. That's pretty bad. Like, flip a coin, throw darts, right? I can give you an example. In March 2021, the FOMC projected that interest rates would still be zero in 2022. The actual 2022 rate was 1.75%. And in 2023, the vast majority of FOMC members thought the rate would still be zero, and the actual rate was over 5%. Of course, that was back when they were telling you that inflation is transitory. And this is a dirty little secret with central bankers. Their talk is as important as the actual policy moves that they make. I like to call it open mouth operations. They open their mouth, they say things, and markets move. And we see it all the time. Jerome Powell will get up and make a speech, and you'll see stocks tank or maybe stocks rally depending on what it is he says. So this talk, it's not just idle chatter. They're thinking very carefully about what they're saying. Half the time they're trying to gaslight you, and then the other half of the time they're just trying to signal what's going on because nobody in the economy, nobody in the world of finance wants a surprise. So when you start hearing that the Fed is probably going to do this or the Fed is probably going to do that, you can almost chart it at the time because that's how they work. They're forward-looking. So these open mouth operations are extremely important, but what's really important is watching what they do because what they say may or may not turn out to be the reality. Now, what they say is definitely going to shift markets in the short term, but what they're actually doing is what is really, really significant. So here's why any of this matters. The Fed is cranking up the inflation machine. The money machine is about to go brrrr, and we already have elevated inflation. Now, we're going to see just how elevated when we get the November CPI data, which is going to come out tomorrow. And again, remember, we didn't get any October data because the government was quote unquote closed. But yeah, the central bankers at the Fed are revving up the inflation machine while trying to convince you they are diligently fighting the inflation dragon. So they're talking like hawks, they're acting like doves. They're playing both sides of the coin, they're walking a tightrope. Eventually, they're going to fall off one end or the other. I can almost guarantee it's going to be the inflation side of the tightrope. But that's what they're doing. They made two concrete moves to loosen monetary policy, but they said some things to make you think they might not loosen much more. Bear in mind, we got this same song and dance at the November meeting. Remember that one? Powell cut rates, and then he got up there and he talked about, the December, we're not thinking that we're necessarily going to cut. We may be done. They weren't done. Here we are. I suppose the Fed could theoretically do these hawkish cuts all the way to zero. And again, I cannot emphasize this enough. This money creation and credit expansion is inherently inflationary. It is the historical economic definition of inflation. And when we have this monetary inflation, then you should expect rising consumer prices, rising asset prices to follow. And we're already seeing the inflationary impacts of the rate cuts that the Fed has already delivered, even before they started this new round of QE. And I don't need tomorrow's CPI report to confirm it. I can look at money supply data. Even if we get cooler than expected CPI data tomorrow, and everybody's all excited because inflation is dead, it's not. Because, again, I can look at the money supply data, and when I do, I find the money supply is already growing at the fastest rates since July 2022. That was in the early stages of the Fed's tightening cycle. So if you go back and you look at the trajectory of the money supply, and the Fed keeps a nice chart of this, the M2 money supply, after peaking in April of 2022, the money supply began to decline as the Fed hiked rates that year. And then the money supply bottomed. It fell, and it bottomed in October of 2023. So a little over a year and a half that we saw the money supply actually declining. We actually had disinflation for a bit. And then it began increasing again when the Fed started cutting interest rates. The money supply is now well above the pandemic peak. And money creation has actually accelerated over the last several months. So based on the true money supply, or TMS, which is a metric that was developed by economists Murray Rothbard and Joseph Salerno to provide a more accurate measure of money supply fluctuations. Based on the TMS, the money supply grew at 4.76% year on year in November. That was up from the September increase of 4.06%. Money supply growth was also up significantly compared to October of last year, when year-over-year growth was 1.27%. So you can see how much the expansion of the money supply is accelerating based on the TMS. August, September, and October all posted some of the largest month-on-month growth rates we've seen since 2022, rising 1.18%, 1.4%, and 1.14% respectively. So this is month on month. Money supply growth, as measured by the Fed's M2 metric, is surging even faster. Year over year, it grew by 4.63% in October, up from 4.47% in September. M2 is now at the highest level it's ever been, at nearly $22.3 trillion. The TMS metric has not returned to its 2022 peak yet, but it is running at a 34-month high. So all of this tells you that money creation is accelerating. Inflation is speeding up. So, if we want to go back and kind of look at the bigger picture, the central bank has expanded the money supply at an exponential rate since the 2008 financial crisis. Based on the TMS metric, the money supply has grown by over 200% since 2009. Or, if you want to look at it another way, more than 2/3 of the current money supply has been created since the financial crisis. That's a lot of inflation, right? A lot of money creation there in a very short period of time. And this is exactly why prices spiked after COVID. It was no surprise when the Fed people were running around telling you, oh, inflation is transitory. I knew that it wasn't transitory. It was the inevitable result of all of this money creation, especially combined with COVID-era government policy. Now, it's really important to remember, and I've already mentioned this, but I want to kind of emphasize this. Rising consumer prices are just one symptom of monetary inflation, right? We also get asset inflation. So the stock market goes up. You get these rapid stock market bubbles because of the air, which is really just this easy money pumping them up. Real estate prices will go up, right? During the quantitative easing era in 2008 and the ensuing years, we got very little consumer price inflation. In fact, it's interesting because a lot of conservative economists in 2008, 2009 were warning, oh my gosh, you're printing all of this money. We're going to see this huge inflationary spike. We could even see hyperinflation. And consumer prices were rather tame. But if you go back and look at how much the stock market went up. Look at how much real estate prices went up during that period. That is a result of this inflation. It was due to the way government policy was structured at the time. It incentivized that money to stay in the financial system. When we got to COVID and we had the next massive round of quantitative easing, the government policies that were in place, which were largely stimulus, right? We were getting checks. People were getting money for doing nothing. They were sitting at home playing video games, but getting paid. And so they were going out and buying stuff. So we had this massive increase in spending because everybody had this extra money, but nobody was producing anything. So that was the perfect storm to create a situation where a lot of that inflationary pressure went into consumer prices. Now, where is this round of inflation going to go? Well, we'll have to wait and see. I would say probably a little bit of both. We're going to get continued consumer prices rising, and we're going to get asset inflation. We're going to get the bubbles. That is until the bubbles pop. Right? The point I'm driving at is that even if consumer prices aren't going up super fast, that doesn't mean there isn't a lot of inflation. If we get a cool CPI number tomorrow, it doesn't mean there's no inflation. Go look at those money supply charts. That's how you know what's actually going on with the inflationary picture. The fact that the money supply growth has ramped up since the Fed began cutting interest rates underscores a very important point. The central bank doesn't have to create money through quantitative easing to increase the money supply, right? I've already mentioned this as well. Artificially low interest rates are inflationary in a fractional reserve banking system. When a bank makes a loan, it creates some amount of money out of thin air. They deposit new money into somebody else's account. That money didn't exist before, and they can do that because they only have to have like 10% reserves for all of the loans that they make. So when the government and the Fed are incentivizing borrowing in order for you to spend more, they're also incentivizing inflation and increasing the money supply. And now we're going to get quantitative easing or whatever in the world they're calling it on top of that. Again, money printing. So, as I've already said, the money printer has been ratcheted up. Money printer is going brrrr. We're printing a bunch of money. Now, you might be listening to me and you might be thinking, well, if Mike is right, then the Fed is just stupid. They shouldn't be cutting rates, given everything that Mike has just said. And you also might be thinking, well, maybe Mike is wrong because surely these brilliant policymakers couldn't be making such a horrible mistake. I mean, my listeners probably aren't thinking that, but I know if a lot of people out there in the mainstream heard this show, that's exactly what they would say. Well, Mike, you can't question the Fed. These people are way smarter than you. They know what they're doing. And I don't know, maybe they do, because there is a case for more monetary easing, more rate cuts, more quantitative easing, despite inflation, right? It's like voting. It just depends on which evil you want to pick, inflation or a crashing economy. As I've explained over and over again for months, the reality is the Fed is in a catch-22. I mentioned it earlier in this show. It simultaneously needs to hold interest rates higher to deal with inflation, and it also needs to cut rates to keep the economy from being completely sucked into the debt black hole. Make no mistake, no matter what you hear coming out of the mouth of the Fed officials, they've picked inflation. That's the evils they've chosen. That's what we're doing, right? They can't do both. They can't cut rates and support the economy and simultaneously fight inflation. So they have to pick one, and they're going to allow inflation to keep going. They're going to pick the economy over inflation. The bottom line, what's really important, the message you need to get from this show, as a normal person out there who can't control what the Fed people do, you got to watch what they do and stop listening to what they say. In fact, you can almost completely ignore what they say. The open mouth operations are a deflection. They're gaslighting as they keep relentlessly devaluing your money. Remember, inflation is a matter of policy. And always be aware of the fact that they are gaslighting you to try to make you think that you actually need inflation, right? Inflation is good for you. Conventional wisdom holds that falling prices are detrimental to the economy. We can't have deflation. Oh my gosh. Well, once again, conventional wisdom is wildly wrong. If you are a sane person, you understand this. In fact, most people right now probably wish prices would go down right about now, right? Nobody pulls up to the gas pump and sees that gas is 20 cents a gallon cheaper and goes, oh my gosh, we have falling prices. The economy's in trouble, right? No, falling prices undoubtedly would help your quality of life. But the reality is deflation is bad for the government. It's not a problem for any normal person or the economy more broadly, but it is a problem for government. So that's why government doesn't want deflation. It has nothing to do with protecting you. So there was a recent post on X, and somebody trotted out the conventional wisdom, and they claimed that we need fiat money that the government can incessantly print because, quote, it became a necessity when the inelasticity of gold-backed currencies failed to accommodate aggressive economic growth. However, as economic historian Tom Woods pointed out, this is a ridiculous notion, and it's easily disproved by looking at American economic history. The United States actually became an industrial power in the 1800s, even as prices were falling, and as the country was operating with this inelastic gold-backed money. And this is how Woods explained it. He said, if there's more economic activity, you don't need more money to accommodate it. Prices simply fall so that the same amount of money can process the increased number of transactions. It's no big deal. Now, when faced with this logic, proponents of the fiat system will tell you that hard money exacerbates or even causes depressions. And that's also wrong. Two economists, Andrew Atkinson and Patrick J. Kehoe, published an article in 2004 that was titled Deflation and Depression. Is there an empirical link? And this was published in the Economic Review. Good news, there isn't. The study authors evaluated evidence from 17 countries over a 100-year period and came to this conclusion, quote, a broad historical look finds more periods of deflation with reasonable growth than with depression, and many more periods of depression with inflation than with deflation. Overall, the data show virtually no link between deflation and depression. But don't falling prices discourage investment? Doesn't this prevent economic growth or at least stall it? No, doesn't do that either. Falling prices don't discourage investment because when you have falling prices, costs also fall, right? After all, costs are just the price of inputs. So as Woods notes, as long as there is a spread between input prices and output prices, investment remains unaffected. Quote, part of the entrepreneur's job is anticipating future prices. Entrepreneurs bid on the factors of production in anticipation of what they believe the finished product can fetch on the market. If they believe that price is going to be low, then they lower their bids for the factors of production, and the whole thing is a wash. If the entrepreneur fails to anticipate this, then it's like any other entrepreneurial error. In the worst case, he goes bankrupt and his resources are redistributed in bankruptcy court. Production continues as before, but with new owners. And this obviously has no overall effect on the economy, end quote. So the idea that falling prices are bad is nothing but gaslighting by the government and its enablers in academia and the corporate media. They need constant monetary inflation to support government borrowing and spending. That's what this is all about. Fiat money is fuel for big government. They want you to think it's good for you because they need it, but you don't. So they want you to believe that falling prices are bad for you, even though you know in your heart of hearts they aren't. That way, they can keep printing and claim they are protecting you from the horror of paying less for things tomorrow than you are today. Don't fall for it. And I've gotten to where I say this every week, but I think it's important to remember, these aren't policies that you can vote away. This is kind of structural in our system today. Inflation is just part of life. So you're not going to get rid of it. You have to learn how to deal with it. You have to learn how to work around it. You need to protect your wealth with real money, gold and silver. The fact that gold and silver keep going up and up and up are telling you something. It's a signal. It's telling you that this relentless devaluation of your money is ongoing. And so you have to do something. If you save in dollars in 10 years, those dollars are going to buy far less than they do today. That's almost a guarantee. I mean, I would call it a guarantee. It's about as close as a guarantee as you're going to get. So you want to have real money. So that's why you need to talk to a money metals, precious metal specialist. Do it today. Call 800-800-1865. I say this all the time. These folks are fantastic. They're knowledgeable. They love to answer your questions. They'll help you figure out how precious metals can fit into your investment portfolio, how they can help you protect your wealth, what products will be good for you. So do it today. 800-800-1865. If you don't want to talk on the phone, you can go to moneymetals.com and you can chat with a precious metals specialist just via text chat. Or if you know what you want, you just go to moneymetals.com. You can buy, we'll ship it to you, or you can store your gold and silver in our state-of-the-art bullion depository located in beautiful Eagle, Idaho. So do it today because your money is not going to get more valuable over time unless you have real money, gold and silver. So with that, we're going to call that a wrap for this episode of the Money Metals Midweek Memo. You can get more information about everything that I've talked about on the show and a lot more over at moneymetals.com/news. And if you want to get the latest news and information relating to gold and silver right in your inbox, make sure you sign up and get on our email list. Of course, you can subscribe to the Midweek Memo on your favorite podcasting platform. And when you do, you'll also be able to tune into our Market Wrap podcast that runs every Friday, where you're going to get a quick overview of the week in precious metals, along with conversations between yours truly and interesting people from the world of gold and silver. This week, I'm going to be talking to economist Peter Earle about the gold standard. So always an interesting subject. Check that out. Thank you again for listening to the show. I really do appreciate it. Remember, give us those thumbs up, share the episodes, and I hope you have a fantastic rest of your week. I will be doing a show next week, but I'm going to release it on Tuesday instead of Wednesday on Christmas Eve. So you can look forward to a midweek memo next week, just a day earlier. Thanks again. Get ready for the holiday, and I'll talk to you again on Tuesday.